Walk into almost any shopping centre food court in Sydney, Melbourne or Brisbane right now and you will notice something that would have been unthinkable a decade ago. Empty shop fronts where restaurant chains used to be. Darkened signs behind locked glass doors. Stripped out kitchens with the lease notice still taped to the window. Australia's restaurant industry recorded 109 chain-level closures in 2025 alone. And 1 in 11 hospitality businesses in the country is expected to collapse before the end of 2026, according to Restaurant and Catering Australia. Insolvencies across the broader economy were already up 57% year-on-year heading into this period, and the food sector has been hit harder than almost any other. Spending at cafes, restaurants and takeaway food services has remained essentially flat since early 2023, while operating costs for rent, utilities and ingredients have soared to record levels. Some of the biggest names in fast food and casual dining are bleeding stores, bleeding money, or both. And the brands on this list are not small players. These are chains your parents took you to on Friday nights. Chains that used to have queues stretching out the door. Chains that, in some cases, spent hundreds of millions of dollars trying to win over Australian customers and still could not make it work. So what went wrong? These are 8 major restaurant chains that are dying in Australia in 2026. Number 8. Starbucks. If you want to understand how badly a global giant can misread the Australian market, the Starbucks story in this country is the textbook case. The Seattle coffee chain arrived in Australia in the year 2000. Convinced it could dominate here the same way it had dominated across the United States, across Europe, and across Asia. Within 8 years, Starbucks had opened 84 stores in cities from Melbourne to the Gold Coast. On paper, it looked like an unstoppable expansion into a coffee-loving nation. It was anything but. In those first 7 years of trading in Australia, Starbucks racked up losses totaling $105 million. The company borrowed $54 million from its American headquarters just to keep the lights on in its Australian stores. And then, in 2008, the axe fell hard. Starbucks shut down 61 of its 84 Australian outlets in a single wave of closures. The headlines at the time were brutal. Industry analysts called it one of the worst international retail expansions in modern Australian history. The problem was never the coffee itself. The problem was that Starbucks walked into a country that already had one of the most developed coffee cultures on the planet. Italian and Greek immigrants had brought espresso culture to Australian cities decades earlier, long before Starbucks even existed. By the time the Seattle chain showed up with its sugary frappuccinos and its standardized menu boards, Australians already had a local cafe on every corner, serving flat whites made by baristas who actually knew their craft. Andrew McKay, Vice President of the Australian Coffee Traders Association, put it simply at the time. He said the whole Starbucks system and the way they served just did not appeal to the coffee culture that had already taken root here. Australians prefer strong espresso-based drinks. They want their food alongside their coffee. And they were not interested in paying a premium for a brand that felt corporate and impersonal compared to the independent cafes they already loved. Today, Starbucks still clings to around 51 locations across Australia, mostly clustered in tourist-heavy precincts and near universities with large international student populations. In 2014, Starbucks sold its remaining Australian stores to the Withers Group, the same company behind 7, 11 in this country. Globally, the picture is equally grim. In late 2025, Starbucks closed 627 stores as part of a $1 billion restructuring plan called Back to Starbucks, with over 90% of those closures hitting North America. The Australian operation remains a footnote in the company's global empire, and a cautionary tale about what happens when you assume what works in one country will automatically work in another. 26 years after arriving in Australia, Starbucks still has fewer stores here than Zambrero has burrito bars. Number 7. Subway. Subway was once the undisputed king of quick-service restaurants in Australia by sheer number of locations. At its peak around 2015, the sandwich chain operated roughly 1,444 stores across the country. Walk through any suburban strip mall, any petrol station precinct, any university campus, and there was almost certainly a Subway within a 5-minute drive. The brand was everywhere. Fast forward to 2026, and that number has dropped to around 1,255 stores. That is nearly 200 locations gone in the space of about 7 years. And the decline in Australia mirrors an even more dramatic contraction in the United States, where Subway has shed over 7,600 net locations since its peak of 27,100 stores. In 2024 alone, over 1,000 American Subway locations shut their doors permanently, according to the company's own franchise disclosure documents. The chain fell below 20,000 US stores for the first time in 2 decades. So what happened to the franchise that once bragged about having more locations than McDonald's? The short answer is that Subway grew too fast, placed too many stores too close together, and then watched helplessly as average sales per store declined for 8 straight years. Franchisees who had invested anywhere from $200,000 to $500,000 found themselves competing not just with other food brands, but with the Subway store 3 suburbs over. In franchise circles, they call it cannibalization, and Subway suffered from it badly. In Australia, the competitive landscape shifted beneath Subway's feet as well. Guzman y Gomez added 27 net new stores in 2025. Sushi Hub opened 22 new outlets to reach a 200 store milestone. Health-conscious Australians who once grabbed a 6-inch sub started drifting toward what they saw as fresher, more exciting lunch options. The value proposition that once made Subway attractive began to erode as ingredient costs pushed sandwich prices higher, while the food itself stayed largely the same. Subway has attempted a brand refresh with a new signature menu designed to simplify ordering and reduce decision fatigue. A concept first launched in the US in 2022 and brought to Australia in early 2025. The chain still leads the country by total store count, sitting ahead of McDonald's and KFC. But the gap is narrowing every single year, and the trajectory tells you everything you need to know about where this brand is headed. What was once a story of unstoppable growth has become a slow, steady retreat that shows no signs of reversing. Number 6. Pizza Hut. There was a time when Pizza Hut was the undisputed ruler of pizza night in Australia. The Red Roof restaurants with their all-you-can-eat salad bars and thick pan pizza were a suburban institution through the 1980s and 1990s. Families would pile in on a Friday evening and kids would fight over the last slice of Super Supreme while parents lingered over garlic bread and soft-serve ice cream. For an entire generation of Australians, Pizza Hut was not just a restaurant, it was a weekend ritual. That era is long gone. Globally, Pizza Hut's parent company Yum! Brands announced in early 2026 that it would close approximately 250 underperforming locations across the United States as part of a turnaround strategy called Hut Forward. Same-store sales had dropped a full 5% over the prior year. Franchisee bankruptcies became a recurring headline, with one major operator called EYM Pizza filing for Chapter 11 protection, owing more than $21 million to creditors. And perhaps most telling of all, Yum! Brands openly admitted it was considering selling the entire Pizza Hut brand outright. In Australia, the chain operates around 260 stores under Flynn Group, the world's largest franchise operator, which took over the master franchise license in mid-2023. Flynn bought the Australian business from investment firm Allegro Funds for a valuation below $50 million, which should tell you something about where the brand sat at that point. To Flynn's credit, the Australian operation had posted an impressive 50 consecutive months of same-store sales growth leading up to the acquisition. Flynn's CEO, Greg Flynn, called the Australian stores high-functioning and profitable, and said he could see the network reaching 500 locations within a few years. But the global headwinds are impossible to ignore. The fundamental problem for Pizza Hut is that it built an empire around a dine-in experience that Australian customers stopped wanting years ago. Close to 90% of new Pizza Hut locations being built worldwide are now smaller Delco formats, short for delivery and carry-out, because the old-style dining rooms with their salad bars and jukeboxes are simply too expensive to run. Domino's figured out digital-first delivery years ago. Pizza Hut is still catching up, still converting those oversized restaurants into leaner models, and still losing ground to faster, cheaper, more digitally savvy competitors. Number 5. Retail Food Group. If you have ever grabbed a coffee from Gloria Jean's, picked up a loaf from Brumby's, bought a cinnamon donut from Donut King, or ordered a pizza from Crust, you have given your money to Retail Food Group. The Gold Coast-based company is Australia's largest multi-brand food franchisor, and right now it is in serious trouble. In the first half of the 2026 financial year, Retail Food Group reported that its underlying earnings before interest, tax, depreciation, and amortization had collapsed by 43%. Domestic sales fell 1% to $254.6 million, and the company lost a net 29 stores from its network. The opening of 22 new outlets was nowhere near enough to offset the closures and site exits happening right across the portfolio. The problems run deep and they stretch back years. Retail Food Group tried to sell its Brumby's bakery chain but could not find a single buyer willing to take it on. The sale process was abandoned. It axed the Michelle's Patisserie brand entirely. It absorbed the Saibo espresso chain from competitor Retail Zoo for just $2.7 million and began converting those stores into Gloria Jean's outlets in a desperate bid to consolidate. The company also acquired the Australian master franchise license for American sandwich chain Firehouse Subs, hoping a fresh brand might inject some energy into the struggling empire. The first Firehouse Subs restaurant in Australia is expected to open in late 2026. The deeper story here is one of corporate mismanagement that devastated hundreds of small business owners. A landmark 2017 investigation by the Sydney Morning Herald revealed that hundreds of Retail Food Group franchisees had been left financially ruined after investing in brands under the RFG umbrella. The Australian Competition and Consumer Commission later won a civil court case against the company in December 2022, resulting in $10 million in repayments and debt erasures for Michelle's Patisserie and Gloria Jean's franchise partners who had been sold loss-making shops and charged allegedly illegitimate marketing fees. For a company that was once a stock market darling trading above $7 a share, the collapse has been extraordinary. Every brand in the portfolio is now under pressure, and the question is no longer whether Retail Food Group can return to growth. The question is which of its brands will still be standing in 5 years. Number 4. Michelle's Patisserie. Michelle's Patisserie deserves its own entry separate from Retail Food Group because this is not just a story about declining sales or a few store closures. This is the story of the complete death of a brand that once had more than 350 stores across Australia. Michelle's was founded in Sydney in 1980 by French pastry chef Michel Catillon. For decades, it was the place Australians went for birthday cakes, a decent coffee, and a slice of something sweet during a shopping trip. The stores were a fixture of food courts and suburban shopping strips from Cairns to Hobart. By the mid-2000s, Michelle's had expanded into hundreds of locations, and the brand felt as permanent as the shopping centres it called home. Then Retail Food Group acquired Michelle's in 2007 for a mix of cash and shares worth $46 million, also absorbing $54 million in corporate debt from the previous owner. That is when things started to fall apart. In 2015, RFG made the fateful decision to switch the entire network from fresh cakes to frozen product. The quality dropped noticeably. Customers noticed it immediately. Franchisees were furious. The cakes that had once been Michelle's point of difference were now indistinguishable from something you could buy at a supermarket, except they cost more. Then came the scandal. Reports emerged alleging that RFG had instructed Michelle's franchisees to ignore food use by dates, a claim that made national headlines and obliterated whatever consumer trust remained. A Queensland court later ruled that Retail Food Group had breached Australian consumer law by misleading franchisees about quality standards and supplier agreements. The ACCC's civil case ended in a settlement, but by then the damage was permanent. Stores closed by the dozen year after year. The brand that once had 350 locations withered down to just 19 stores scattered across New South Wales, Queensland, and Victoria. And in February 2025, Retail Food Group announced it was killing the Michelle's Patisserie brand entirely. The remaining 19 outlets would be converted to either Gloria Jean's or Donut King. After 45 years, Michelle's Patisserie was gone. Not restructured, not rebranded, not given one more chance. Gone. It stands as one of the starkest examples of what happens when a corporate owner prioritizes cost-cutting over the product quality that made a brand successful in the first place. If you have found this video interesting so far, hit subscribe. We break down the biggest changes happening across Australia's economy every single week, and there is plenty more coming on this list. Now, the next 3 entries get even more surprising. Number 3. Domino's Pizza Enterprises. Domino's Pizza Enterprises is not your average pizza shop operator. It is the largest master franchise holder of the Domino's brand outside the United States, running stores across Australia, New Zealand, Japan, France, Germany, Taiwan, Malaysia, Singapore, and several other markets. For 2 decades after listing on the Australian Securities Exchange, Domino's was a growth machine that investors loved. The share price once topped $80. Then 2025 happened, and the whole story changed. Domino's reported its first ever annual loss since going public 20 years earlier. The company posted a statutory net loss of $3.7 million for the financial year, a staggering reversal from the $96 million profit it had recorded just 12 months before. The result was dragged down by $162 million in one-off charges, primarily from shutting 312 underperforming stores around the world. That included 233 closures in Japan, where demand had cratered since the pandemic boom, and additional closures across France, where the company had struggled to gain traction. When those numbers landed on the ASX, the reaction was immediate. The Domino's share price crashed 20% in a single trading session, plunging to its lowest level in months. Investors headed for the exits. Shortly afterwards, CEO and Managing Director Mark van Dijk confirmed he would be stepping down before Christmas. Executive Chairman Jack Cowin, the billionaire behind Hungry Jack's, took the wheel to try and stabilise the business. In Australia and New Zealand, the numbers were slightly more encouraging. Same-store sales in this part of the business edged up 0.6%, which management described as a win given the strong comparables from the previous year. But the broader picture remained bleak. Net debt sat at around $724 million. The company's expansion strategy, once its biggest selling point, had become the very thing dragging it underwater. The competitive landscape is not making life any easier either. Guzman y Gomez's rise has been relentless, pulling spend away from traditional fast food chains. Local pizza operators are gaining ground, and third-party delivery platforms like Uber Eats and DoorDash have made it simpler than ever for independent restaurants to compete head-to-head with the big franchise networks on convenience and speed. Domino's remains the biggest pizza operation in Australia with 721 stores nationwide. But the aura of invincibility that once surrounded this business is well and truly gone. Analysts now talk about Domino's in terms of margin repair and deleveraging rather than growth, and the share price has never recovered from its pandemic-era highs. The company that once promised to put a pizza store on every corner is now focused simply on keeping the stores it has profitable. Number 2. Red Rooster. Red Rooster is about as Australian as it gets. The chain opened its very first store on Red Rooster Lane in Perth back in 1972, and for decades it was the go-to option for roast, chicken, chips, and a solid family feed at a reasonable price. At its peak, Red Rooster operated more than 375 stores across the country, sitting alongside sister brands Aporto and Chicken Treat under the Craveable brand's umbrella. But the numbers in recent years paint a sobering picture. In 2025, according to the GapMap's annual fast food report, Red Rooster posted a net closure of 1 store. Now, losing a single store might not sound dramatic on its own, but look at what the competition was doing in exactly the same 12-month period. KFC opened a net 29 new locations. McDonald's added 25. Hungry Jack's grew by 16. Even Zambrero, which is a fraction of Red Rooster's size, managed to add 31 net new stores, while the industry around it set a record for net new openings with 250 stores added in a single year. Red Rooster could not even hold its ground. The troubles go back further than last year. In 2017, private equity owner Archer Capital attempted to float Craveable brands on the ASX. The company presented investors with projections showing annual sales of around $742 million and net earnings of roughly $26 million. The roadshow presentations in Melbourne and Sydney were, by all accounts, underwhelming. The IPO was pulled. Institutional investors simply were not convinced that Red Rooster had a credible path to meaningful growth. Archer Capital had originally bought the business in 2011 with ambitious plans to expand into New Zealand, China, the United States, and the United Kingdom. Those international ambitions largely went nowhere. Store counts for both Red Rooster and Chicken Treat actually declined during that period. Red Rooster has recently launched a fresh brand campaign in an attempt to reposition itself for a new generation of Australian diners. But the chain faces an uncomfortable squeeze from both sides. On one hand, KFC dominates the fried and roast chicken space with massive global marketing budgets and supply chain advantages that a domestic operator simply cannot match. On the other, Australians now have more casual dining options than ever, from Nando's flame-grilled peri-peri chicken to their trusted local charcoal chicken shop that has been feeding the neighbourhood for 20 years at the same honest price. For a brand that once defined chicken takeaway across suburban Australia, Red Rooster increasingly looks like it is stuck in neutral, while the rest of the fast food industry accelerates past it. The question facing its owners is whether a heritage brand with loyal but aging customers can reinvent itself fast enough to compete in a market that is moving at a pace nobody predicted even 3 years ago. Number 1. Taco Bell. If there is one restaurant chain that perfectly captures the challenge of cracking the Australian market, it is Taco Bell. Not because it failed once, not because it failed twice. Taco Bell has now failed in Australia 4 separate times since 1981. 4 attempts spread across 4 decades, and not a single one of them has truly worked. The first attempt came in 1981 and fizzled almost immediately. A second run in 1997 fared a little better, but still petered out after about 8 years of trading. Collins Foods, the ASX-listed company that also operates hundreds of KFC stores across Australia and Europe, stepped in during 2017 betting that the third time, or technically the fourth, would be the charm. Collins opened 27 Taco Bell stores across Queensland, Victoria and other states. The company invested heavily and believed that the growing Australian appetite for Mexican food would finally give Taco Bell the foothold it needed. It did not happen. By the half-year ending October 2025, Taco Bell revenue in Australia had slipped nearly 4%. The entire division generated just $500,000 in profit across all 27 stores for the 6-month period. To put that in perspective, that works out to roughly $18,500 per store over half a year. You would make more money running a weekend market stall. In April 2025, Collins Foods made the call. It announced it intended to exit the Taco Bell business in Australia entirely, either by finding a new operator or by winding the chain down completely. Collins stated it wanted to refocus entirely on its core KFC brand and on its rapidly growing European operations, particularly in Germany, where the company plans to open between 40 and 70 new KFC restaurants over the next 5 years. Then, in March 2026, with the deadline looming, Collins signed a deal at the 11th hour. 20 of the 27 Taco Bell stores would be transferred to Restaurant Brands Australia, a long-term global partner of Taco Bell's parent company Yum Brands. The remaining 7 locations, 6 scattered across Queensland and 1 in Victoria, would close permanently. Collins estimated the closure costs at between $1 million and $2 million. The lease liabilities for all 27 stores totaled around $24 million. David Mantellini, general manager of Taco Bell Australia, described the ownership transfer as an important moment for the brand and said the new partnership would help make Taco Bell more accessible across the country. Restaurant Brands Australia and Yum Brands plan to finalise the deal between June and August 2026, pending landlord consents and ACCC clearance. Staff at the 20 continuing stores will be offered jobs under the new ownership. But the reason Taco Bell keeps failing in Australia comes down to a single brutal reality. It arrived too late to a party that homegrown brands had already taken over. Guzman y Gomez opened 27 net new stores in 2025 alone and has built a fiercely devoted following with a menu that feels local, fresh, and fast. Zambrero added another 31 stores in the same year. Both of those brands understand Australian tastes in a way that Taco Bell, with its imported American recipes and branding, simply does not. When Australians want Mexican food in 2026, they already know exactly where to go. And for most of them, It is not Taco Bell. After 4 attempts stretching back to 1981, it is hard not to wonder whether Taco Bell's moment in Australia has already come and gone. The new operators may prove everyone wrong, but history is not on their side. These 8 chains tell a bigger story about what is happening in the Australian restaurant industry right now. Rising operating costs, rapidly changing consumer tastes, and a wave of confident homegrown competitors are reshaping the landscape faster than legacy brands can adapt. The hospitality industry recorded its worst insolvency figures in years through 2024 and 2025, and the pressure heading into the second half of 2026 is not letting up. New international chains like Popeyes, Chuck E. Cheese, and Firehouse Subs are already announcing plans to enter the Australian market, which means even more competition for the brands already struggling to keep their heads above water. The chains that survive the next 5 years will be the ones that stop trying to import overseas playbooks and start genuinely understanding what Australian customers want from their food, their service, and their dining experience. The ones that do not adapt will join this list. If this video gave you something to think about, subscribe and check out the video on screen now for more on the biggest economic shifts happening across Australia right now. I will see you in the next one.